right. Ding, 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 ding. How you guys doing? You ready? Jumbo! Jumbo, let's go! Boom! Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Chicka, 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 Slim Shady. Two trailer park girls round the outside. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Ni hao ma! How are you today? My name is Wayne McDonald. I'm a currency trader, and today we're going to do currency trading because we're at this thing called Forex.Today. So we can take a look at the calendar. I forgot to do that yesterday. I know it's Wednesday, but it's actually only the second trading day of the week, even though the markets are open and blah, 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 blah. But I think there's a bunch of like central bank stuff coming up today, tomorrow, next day, whatever. So we'll do that at the Forex.Today calendar. We'll do that today. I'll try to answer your questions, address your concerns. Please take notes. Please write things down. I notice that a lot of you now are actually documenting your takeaways in the comments of the recording so that you can search your own archives and bring up lessons. And I notice that you're also time stamping. So that's the way I would do it if I were me. So awesome stuff, right? Now you have an archive that you can search, a knowledge base, if you will. So very cool. Thank you for being here. Thank you for subscribing. Thank you for treating each other with dignity and respect and treating these webinars. Sure, they're fun and all that kind of stuff, but ultimately we are professionals and this is our career. And so thank you for taking everything seriously and acting professionally. I'd like to thank our sponsor, TradersWay.com, for being our sponsor, for supporting our community and all that kind of stuff. So please pay it back. They're a broker, you're a trader. Look. Seems like it might be a good fit, right? So give them an opportunity to earn your loyalty and respect. And even though these webinars don't cost you money, they do come with a cost. You are morally obligated to visit tradersway.com, open up a demo account. You can download MT4, you can download MT5, you can download C-Trader, you can have an ECN account, you can have a variable spread account, you can have a fixed spread account, okay? But test it out, play some trades, execution's fast, spreads are small, swaps are big. So it's everything that you're looking for. Give them a chance. Tradersway.com. Thank you, Tradersway.com. Boom. Welcome. Welcome one. Welcome all. Looks like I could probably get a little more chart in there. Yeah, nice. Cool. So I'm super happy to be here. I'm super happy to be alive. Let's see if we can turn the ship around. Or if you're a bear, keep the party going. How are you doing? Okay. How are we doing? How are you doing? Yens have been strong the last couple of days. Okay. Again, right off of the first day of the month. Interesting. Maybe you should take note of that. Okay. But again, where do you believe we will be, or where do you want to be in 3 months? Okay? That's the other question, right? So you have to line up market conditions with long-term fundamentals. Okay. So like, for example, technically euro dollar here, our buddy euro dollar, I would say is technically still bearish on this hourly chart. I look at various things and I would use my drawing tool, except it's disappeared. Where'd it go? I thought, oh, there it is. Cool. Got to move that over there. All right. So technically, it became bearish here on September 2. On this 1 hour chart on September 2, technically, like quite literally the technical definition that I use is the 2155 crossover, which represents the market. So the market technically in Asia, it looks like, became bearish. Cool. And has remained bearish. And is there still, therefore, still bearish. So you're either defending your positions from earlier by, moving your stop to break even, or if you're a bull, you're still waiting. You're just waiting and waiting and waiting. And how long does it take to turn on an hourly chart euro dollar from bullish to bearish? Looks like it takes an entire day. So you'd have to wait one whole day. But what if you were going to be in the trade for 90 days? Because you said, well, by the end of the year, euro dollar will be up. Can you afford to wait one whole day? Or is it too late? Too late for love, too late. Yes, it's too late. Too late, too late. And you're like, man, it sucks. I was only profitable 89 days, right? So I just want to put that in the back of our minds, okay? Okay? Dixie was dropping. Well, over this period, it was rising. All right. So right now, if you're a bear or you're day trading or you're intraday trading, what does this tell you? Should you be buying the dips? No. Can you sell the rallies? Yeah. Okay. So down, up to the 21, sell. 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 Down. Okay? So you can be short-term short. Right? Which means day trade down, but you can wait to be long-term long. Which means on the higher time frames, you're looking at key levels of support in which you would anticipate a return to bullishness. And therefore, then you go back to euro dollar on the 1 hour, and it, let's say, runs into daily support, and you're like, yeah, well, around this price, I think it would turn up. And then you wait for your 21.55 cross as evidence and confirmation, and then you day trade the other way as it's going up, down, buy. Up, down, buy. You got it? These shorter term charts just tell you what is, and your longer term charts will tell you sort of like what should be. Okay. So we're at 17.5. Would you buy it at 17? For example, the 55. Let's do it this way. Let's do it this way. This not only would continue in a direction like this, but it also shifts a little bit left over time. So it's going to look more like that in the future. Okay. So maybe there's a convergence, let's say around 17. Would you buy it here if it held? What do you think? Would you buy it there if it held? The most important thing is you're paying attention there. And then, of course, the next thing is Pachow. I think buck 15 would be a psych level. What are your thoughts? Hey, what are your thoughts? Well, my chat's not updating. Are you guys chatting? How about just this? Type anything if you're not going to answer the question. I don't think my chat's updating. Oh, there you go. Yeah, all right, thanks. I guess, okay. I guess I won't ask you questions. Okay, well then we'll just move on. We are in a exit zone for bears. Okay, but let's back out a little bit. Try to find our context. Okay. Cool. So here we are. We went from monthly M3 into the exit zone. So what do you want to do with this? Well, this should be profit taking. Okay. So even though I can see this has made a lower low, and I think technically you would think something like this, which is absolutely fine. I think what I want to do is look for something like this. And we know if you hit your target early, and this is, it's well within the first third of the month, right? So it's before the half. So I think technically this could be early, and there might be a resumption or return back to the central. So I think I'm going to try to play it that way. Okay. Okay. And of course, the thought process behind that is seasonality. Which is a form of fundamental analysis, but with a pattern to it. And therefore, like any kind of pattern, there's some sort of assumption built into it that dollar will weaken. That's all. So there's some fundamental and a fundamental pattern. So the fundamentals would be the actual and implied future monetary policy. Monetary. Sorry. Monetary policy. Okay. So, based on the future and implied monetary policy of the United States, my general assumption is the dollar will weaken. So maybe not today, okay? Maybe not this hour, but in general, okay? The market. And then the other assumption is based on seasonality, which is the pattern of the ebb and flow of money around the world. And remember, the ebb and flow of money around the world is simply human activity. And you're like, well, humans are hard to predict. Yeah, the farmer can make any choice he or she makes. The farmer could choose to wake up in February in Saskatchewan and plant wheat. The problem is it would be very difficult being negative 40 Celsius and the ground frozen and covered in snow. They could try to do it and take the tractor out there and try to till the field. No one could, right? No one would stop them, but it wouldn't be a smart idea. So more likely, they're going to try to plant somewhere after the snow thaws, but before summer. So we'll call that spring. So somewhere in spring, more like in Saskatchewan, it'd be like May-ish, they might plant. But they can plant whenever they want. So at the end of the day, are we actually making free decisions? I know now we're talking Matrix and a bunch of other movies. Like, do we truly have free will? The farmers always tend to plant around the same time, always tend to harvest around the same time. And therefore, we're reasonably predictable. Okay? Like, for some reason, we all have to go on holidays the same weekend and pay twice as much for everything. It's the dumbest thing ever. I'm like, why would I want to party on, like, 4th of July? Right? Everything's expensive. But anyways, I'm Canadian, so everything's expensive, right? All right. So anyways, so we are predictable. So I'm trying to throw those couple of things in there. But technically, this is down, 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 down. But I'm most interested in what if these technicals break the trend and actually show signs of up. Then I can reinforce my thought process and say, well, this is where I anticipate bears to exit. Now, they don't have to. That's where I'd anticipate them to exit. And then based on my thought process, I know it's a lower low. I know this really sucks for me. But if I'm cautious and patient and enter my trades and manage the risk very carefully, I might be able to tiptoe my way up and see my fundamental planning come to fruition. You got it? You see? So I'm not saying it's there. I'm not saying it exists. I'm not saying it's something you should be doing. But I am trying to explain how I'm putting this into a technical plan and trying to be strong and wait for the patience and discipline, right? To do what I need to do. But at the same time, you could day trade this down. I can't day trade this down. Now, the euro dollar might have been, reasonable, but I can't do that on this. By the way, I think I've added the watermark to this now, right? So confluence, yeah. Okay. Neat, right? Okay. So, do you understand what I'm looking at right now? Even though it's Wednesday, I'm thinking about front running next week. And next week, if the pip gods are with me, right? We're on our way to 132.50. Okay, I know we're at 129.20. Okay, of course, my other choice is just get the heck out of the way. Okay. All right. Kiwi. This one's behaving a lot better because this is where you'd expect bears to sell, and this is where you'd expect bulls to buy. Cool. Okay. So there's no major breaches. So I don't know, maybe this one works out. So if I take the same idea of seasonality and monetary policy, okay, I would be looking for this. Okay, up, 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 down, down, up, 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 down, down, up, 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 up. Sometime I'm looking for that. Okay. And you guys might like this, and I'm playing around with it. And but anyways, this is where this might come in handy. Okay. That's too sensitive. Hang on. Indicators too sensitive. I kind of like 34 or 55. Let's just put it back at 55 standard. Calculating. A lot of math. Okay. So now you wait. So what this is telling you is technically on this time frame, bears are getting ready to sell. No, I do not have a favorite pair. I do have a favorite currency. Right? So I actually, Sabatin, I actually dedicated an entire chapter of my book to that question. And why having a favorite pair would be a dangerous proposition. Okay. So anyway, so what we're seeing here, technically, I want you to understand this. This is technically, or no, statistically. This is statistically what's likely to happen under these market conditions. Remember, it's not thinking about a bias, it's creating a bias based on current price action. And the reason I like price action is price can dictate the market condition, where market forces the other way, creating support and resistance like this, that was set in stone last period. Okay? So that doesn't change. But this changes in the moment, right? So right now it's saying, statistically speaking, what's happened before is price action down, and what's likely, statistically speaking, is another price action down. That's just price action trading. Down, 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 up, up, sell, down, 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 up, up, sell, right? And based on how much prices has deviated from the average in the past, if it should do something similar in the future, and there's that. And of course, you can see there's other reasons like just price action, right? Right. And if you looked at this, this would be the old support becomes resistance. So it's just basic price action, right? So there's a lot going on here, and it's not telling you down. It's just telling you, based on what it did before, this is where you'd sell again if you wanted that to continue. But if, on the other hand, you were a long-term bull on this pair, what you would be waiting for is these pivots to adjust from mostly down to mostly up, and now you're doing the opposite. You're doing price action up instead of down, and you're trading standard deviations, right? You're buying standard deviations down, which are otherwise known as a dip. Okay. XX says yen, no, USD. Okay. So if you're a bear, you should be hot to go HOTTOGO. Yeah, you asked that before. I think it was yesterday, Mahai. Um, can you use the law of averages in Forex? Well, first of all, I don't know what law of averages you are speaking of. There are a few. I use the law of averages in Forex as far as the decision making process of whether you should take profit now or later. Okay? And that comes into a scenario like this. Let's say this continues down. Okay? And we get here. And you're trying to decide whether these prices here are dictating M1 or S2. See, because if M3 had held, right? If that held, typically what you're expecting is M1, M3 to M1. So in a scenario where you're thinking, well, should I hang on to get to S2 because it's been down, you've been making money, should you take profit now or here? And the law of averages kicks in and say, well, if it was 50-50, which of course it isn't, but if it was 50-50, like if half the time it went down and half the time it retraced up and never retested, right? So half the time it did this and the other half the time it did this, then the law of averages say, well, then you should just take profit now. And over the course of 100 situations, it would average out to be the same. You will make the same money because half the time it went up and you gave up, let's say, 25 pips. The other half the time it went down and you made 25 pips. So the law of averages say you should just take profit now because it doesn't actually make any difference, but it does because you've actually removed risk as well. Because if you're not in the trade anymore, there's less bad things that can happen. Plus, here's the other thing, because you're not staring at this trade anymore, you're analyzing your charts more clearly, looking for new opportunities to get in. And you've already cashed out of this and moved on because you're like, look, I've done this 100 times. I've done this 1,000 times. And the law of averages tell me, just get out and move on to the next trade. Okay? Gabriel, you just buy it again. A one-time offer is a one-time offer, so you'll have to buy it again. Pay the $5. Okay? What kind of person would I be if I said, this is a one-time offer, but you can get it anytime you want? So it was a one-time offer. So it'll cost you $5. You got it, Gabriel. Come on, Baba. Wayne, could you explain the annual cycle? I know last year's month in advance, you predicted January would be a counter trend. You predicted a similar thing in September as well. Yeah. No, I'm not going to go through that now. All right. Cool. So moveon.com. Let's do some exotics. Keep Raymond happy. Boy, you don't want Raymond to be grumpy at you. All right. Okay. That seems pretty standard. So we have this as a sell. You can see I've already highlighted the sell zone. And we are at 2 standard deviations from the average. So if it goes below this, see, this isn't telling you up. This is telling you it's deviated 2 standard deviations. You're like, well, Wayne, I thought that was up. No. It just tells you it's 2 standard deviations of the mean. So what does that mean to you? Well, if you were a bull, you would say you were going to look for price action to take you up. But you can see by this chart that I'm a bear. So the other thing it could mean is if you go more than 2 standard deviations below the mean, the slope is going to turn negative. You will have negative rise over the run. And what does that mean statistically? Okay, this is M, slope. So if you have negative rise over run, what does that mean? Because it doesn't mean like you should buy it, it means up. Well, dude, no, you have to understand what your indicators are doing. Remember, your indicators don't tell you anything. If anyone tells you MACD told you to buy something, you should fire your guru and move on. MACD is just calculating the distance between 2 moving averages. So if they tell you that means up, they don't know what they're talking about. It's just measuring 2 moving averages. So now you have to interpret it, right? So what does this mean, guys? Type in a question mark just so I know you're listening. Like, do you get it? Do you not get it? Is this old? You're like, dude, we cover this every day. Don't do it anymore. I mean, I don't know what you don't know. And if you don't communicate with me, I don't know what you need. Okay. Well, yeah, it'll create a negative M. And what is negative M? You're right. So now you have negative M. Negative slope. So translate that into a different word that might have meaning to a financial market that we're trading. Downtrend. Thank you. FX noob trader. Boom. Fist bump. Yeah. It means, statistically speaking, on this time frame, on this currency pair that you're measuring, which is Euro-ZAR, okay, EZ, right? It's statistically you have a negative slope. These will start pointing more and more like that. So what does that now tell you? Now you can sell the rallies. Now, is that important information? It is for both bulls and bears, and I'll tell you why. I have my chart set for bears. I'm bearish on this. Can you see this? Let me show you. Indicator. Price biased pivots. Biased pivots. Biased pivots. Biased pivots. There's a bias to the pivots. I don't want all pivots. I just want pivots that fit my bias. I'm in bearish mode. I'm looking at weekly charts, and I'll even throw in conservative and aggressive targets. Okay? Bearish selling zone. Oh, for sure. Okay? Bearish profit target conservative, bearish profit zone aggressive. Aha! Ha ha ha! Oui, oui, oui! Les poissons, hee hee hee, ho ho ho! Right? So this is what it means to me. Okay, what do you think? What do you think? Right? It might have some sort of hope, right? Look at this. Here's your little front run. There's your Friday front run. Check it out. Conservative target, and tickled the aggressive on the last hour of the week. Shut up! Okay, yeah. So anyways, and then what the heck is this? Why are we up here? Nobody knows. Okay, that's not bearish. And then, so we do nothing for a whole week. And then what? Lower low. Okay, and RC Cola is on this. Yeah. Okay. So your stop is probably at or near break even, and you're short at 20, and praying never hurts. Right? RC Cola. All the sugar, twice the caffeine. Okay, what do you guys think? Am I cracking the nut? Much better, right? Okay, so now, thank you, Johnny. Yerzinski. I grew up in Saskatchewan, and there were lots of like Russian and Ukrainian and Polish names, but not with the SKY. Interesting. I had Belinskis as one on one side of the neighbor and Inzioskis on the others. Right? It's just like my whole neighborhood, Russians, Ukrainians, and Poles. It's Irish. No kidding. That's very interesting. What part of Ireland? Johnny's been Saskatoon, pretty city. Okay. Yeah, I used to know every inch of that town. It was back in the day when a kid would get on his bike and ride across the entire city, right? Kids don't leave the neighborhood now, right? Like, oh. But anyway, Blarney. I'm going to look that up, man. There must be some interesting history there, too. Blarney. I'm going to look that up. So I did 23andMe, which is a genetic testing, right? And so if you go to Scotland, there's a whole building just for my family, right? The MacDonald family, the MacDonald clan. You can go all the way back hundreds of years, yeah, to my ancestors and like what day was the burial and how many people showed up for the funeral. That kind of stuff. Like it's really, 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 really well documented. And so like very Scottish, and all that kind of stuff. And then we do 23andMe, and it's really interesting because all of a sudden, wham, way over here in Ireland in one little small town, genetic code. And the genetic code goes, and over time it went from that part of Ireland to the other part of Ireland and then made its way across to Manchester. I'm like, dude, they're migrating for work over like 300 years. They're going where the work is. You're like, how cool is that? It must be related to the famine or something. But anyways, they go from one part of Ireland to the other part of Ireland. Then they cross over, and then they're in Manchester. And then it goes to, what's the one that's more inland? So you got Manchester, and then there's another, anyways. And then finally straight to London. And it's like a straight shot that only took my family like 250 years or something. And they made it all their way to London. But, so it's really interesting. So all of a sudden you're like, oh, there's all my Scottish blood. And then this Irish blood comes in. And yeah, Birmingham, nailed it. Yeah, exactly. So it was just very interesting how you can see it in your genetic code. People, your family history moving, migrating. You can see it. They lived here, they lived here, they lived here, they lived here. And all that kind of stuff. Cool. Very, very interesting stuff. Cool. All right, moveon.com. Yeah, new trader. Well, here's the thing, new trader. So this is always tough this time of the year, right? From the third week of August to the third week of September is always tough. What I find is it needs to break your spirit, and it won't continue up until you've given up. Right? And then you're like, son of a biatch, there it goes, right? But anyways. Is that right, Jeff? That's interesting. If there's a problem, email me. All right, so here's the line in the sand I did. Where was this? Non-farm payrolls? Okay, so let's take a look at the time frame here on the bias pivots. So we're looking at it weekly. Let's try to see if we can explain this. I guess there's a bit of a front run. No, it's just price action, right? Down, 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 up, up, down, 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 up, up, down, 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 up, up, and this just comes from role reversals, which is the basis of price action, right? So you see, like, it's come down. Here's support. Here's resistance, right? Here's support. Here's resistance, right? So it's just price action. It's not a great swing, but this is the monthly goal. You want to be short around 22 and jam your stop and walk. So it's one of those situations. And the yield on this one's pretty good, actually, right? So I'll put it back swing bearish. Swing bear, sweet chariot. So it's not a great weekly swing, but it is. It is what it is. So euros are peso, USDs are is this, and that one's working out purty. She's purty. Okay. Now you might say, well, this says sell. Well, it does, but the bigger issue is you probably don't sell step ups. Okay. But this is now step down. So if you were interested, you have permission to engage to sell up in there. Yeah, but we've already talked about that FT9 multiple times, right? We talked about the problem that the Fed is creating. So we've done this before, so maybe take notes and make sure you got it. The Fed's monetary policy and implied future monetary policy, fundamentally speaking, you would expect the USD to weaken. 40% of all of Forex is euro dollar. So if the dollar in general will weaken, 40% of all that weakening will strengthen the euro. The euro, the ECB, is trying to lower the value of the euro, just like the Fed is. But the Fed is way bigger than the euro because it's a reserve currency. So ECB is entering all these policies to weaken the euro. And son of a gun, because they're trying to weaken it to create inflation, and son of a gun, euro goes up. It has nothing to do with the European economy, has nothing to do with the ECB. In fact, it's counter to what the ECB is trying to do. And because the purchasing power of the euro goes up, inflation falls because you need less euros to buy stuff, which means the relative price is lower, which means falling prices is deflationary, and now, son of a biatch, the ECB's screwed. But, yeah, we've talked about them a million times. But you should understand that consequence. So now the ECB's got to step up and do some crazy stuff if they're going to lower it. Okay? Yeah, get a job, Sabatin. Get a job. Right? Be your own man. Stand on your own feet. Say, Dad, I've been working hard for the last few months and I've saved my money. But you should always set it up, right? You're like, Dad, I got a really important thing I want to tell you. And he's like, yes, son. You're like, it's really important. You might want to sit down. You're like, really? Yeah. Dad, I'm gay. Nah, I'm just kidding. But I do want to buy an online course about trading. Hey, what? Yeah. Euro shooting up. Okay. Do you think it has something to do? Oh, I guess I have to do the calendar, right? I have to do the calendar. I forgot to do the calendar. Come on, Baba. Come on, Baba. Let's go to a website called Forex.Today. 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 If I were a currency trader and I trade the euro. All right. Let's see. So, Bank of Canada coming out in about an hour. Do you think that's going to be important? And do you think you should read the statement? Oh boy. Yeah, of course. Okay. What about tomorrow? Tomorrow, tomorrow. Okay. ECP interest rate decision. ECB monetary policy statement and press conference. Oh my gourd, right? That's important. Well, see, Jim's on top of it. Is it really the euro? Let's see. Euro is going up, dollar is going down, yen is going down. Okay? Aussie's trying. Kitty CAD, well, it's under the pressure because of oil. Swissy is the odd one out. Be careful there. This might be the better trade tomorrow or something. And New Zealand. So it's generally risk on except for Swissy and except for pound. And someone's trade from yesterday on pound Kiwi is working, right? So, right, this is where I'm telling you, I mean, think of how I started this. Where do you think this is going to be in 3 months? That's the question, right? That you're supposed to be asking yourself. So these are all buying opportunities, all of them. Isn't that neat? Or were you chasing the panic? Okay. Now I understand sort of the short run. I think this even sucks monthly, but yeah. When do you hold them and when do you fold them? Right? Like I don't know. I don't know what the analogy is, but I hope over the last week you saw that the markets were moving moving very quickly, very negatively against sort of, let's say, your longer term view. And I hope you found that I focused you on staying true to your bias and your research. Okay? So the question now over the next few days is this your sign? And if so, what are you going to do in the next couple of hours, next couple of days, the next couple of weeks? Can you plan that out? What will you do tomorrow? Okay. Okay. Will you buy a dip tomorrow? First of all, did you get that message? Did I deliver that to you? Even though the stock market's dropped like crazy, Tesla's down 20%, the media is in a frenzy. Is this the crash? Is this the end of the world? And I'm like, stay calm, stay focused. This is not unexpected. You should focus on where you think you'll be in 30 days, 90 days, 120 days. Where do you think you'll be at the end of the year? Are you preparing? Right? If this line doesn't hold, you look for the next price, right? What did we talk about yesterday and the day before? Find your prices first and then wait. Would you buy it at 26? Would you buy it at 25? Would you buy it at 24? Then wait for it to come to these prices. Wait for the bounce. Wait for the confirmation. Did you guys get that message? Did I keep you calm? Did I keep you focused? Or was it just like, go, 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 sell, 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 let's go, go, let's trade, let's do some trades? Oh, that's right. That's cool, Jim. Cool. So my goal is to keep you focused on your plan, because I think most of your value isn't how much money you make trading, but how you behave as a trader. Remember, wealthy people are not looking for you to make a lot of money. They're looking for low risk, steady cash flow. They want consistency more than they want profit. Because think about it. You can't go to a rich person, which is going to be your future client who invests in your Forex fund. And you can't say, if you invest with me, I'll make you rich. And they're like, are you stupid, boy? I'm already rich. So what's your pitch, bro? Right? So that's not what they're looking for. But like we talked about yesterday briefly, and I'm not going to go into a big thing, if they invest into the stock market and get on average 10% a year, if they invest into real estate and get on average 15% a year, and you come in and say, well, I can do 25% a year, and I can show you over the last 5 years over all kinds of changing market conditions of bullish or bearish, bubble and burst, and missiles in the air, and peace treaty sign. Through all of that, I'm a consistent machine that produces 25% a year. You'll have endless amounts of clients. Endless. 25. I'm not asking you to make 250. Okay? If you can do 25% a year, year after year after year after year, holy smokes. Oh my God. Like, I'm not joking. 10, 15 years from now, you'll be turning away clients. Or you'll say, well, our minimum is 25 grand, and then your minimum is 50 grand, and then your minimum is 100 grand, and then your minimum is more than that, right? And you just cull your herd, and after a while, let's say you have a small firm of 25 clients, 100 grand each, you got 2.5 M. Okay? Whatever. At some point, you'll have enough. Okay? You don't want more clients, by the way. More clients are a pain in the ass. But you need their money. And why do you need the money? Let's just focus on that for 1 second, and then we'll get into this. You need client money. You need OPM, other people's money, because if you can get enough that your 20% of the profits pays for your basic expenses, I mean your living expenses, pays your mortgage, pays your insurance, your health care, your savings, pays for your vacation. It's your basic nut. It's like if you had a job, right? So if you had a job and it paid you $125,000 a year, and with that you'd live in a certain type of house in a certain type of neighborhood, and you'd have certain levels of expenses and standard of living. Well, what you want to do is trade other people's money so that their 20% covers is your job. Okay? That's your job. Your job, you're like, well, if I had a job or if you gave up a job, you make 125K. Well, you want, right? So you can figure all that out. How much do you need to trade and what are your returns and what would your 20% be? And you want to grow your account so that these clients are paying for your basic living expenses. Nothing about yellow Lamborghinis and models and bottles. You're not buying bags of cocaine and all this kind of stuff. You're just living your average normal life. But you're doing something that you like and it makes you happy, all that kind of stuff, right? But what about your cash in the fund? So now you got your cash. Huh? So now your cash in the fund goes up 25% a year. So after 10 years, now you maybe grow it to a point where you got your FU money now, right? Right? That's where you want to get, because now yours is growing and 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 growing. Okay? Based on compounding, you're doubling every 3 years, right? And that's how it's always been. So that's how you're going to grow your own account, or if you work for a hedge fund, that's how it's going to be. If you're a trader for a hedge fund, you have a job. You're not going to get filthy stinking rich. You'll have a job. If you're an investor in a fund, you will get filthy stinking rich. Okay? You got to have money in the game if you're going to get filthy stinking rich. You understand that? If you have a job, you ain't going to get filthy stinking rich. That's how it is. All right. Cool. So yeah, are you buying dips? Okay. So we're not through the free and clear zone, right? You understand? This is just a higher low right now. Okay. So we need to get that above, and we also need to turn the push the 21 above the 55. Hua? So technically bearish. Look where it kicked off with the 4-hour 200 EMA, the fair market value, the fair market value, the fair market value. These might be giant resets. There is no 200 EMA. Oh, yeah, 200 EMA here is neutral. Neutral because it's USD yen. That's why I don't trade these two. Okay, look, 200 EMA, 200 EMA, 200 EMA, neutral. Now we're at the 200 EMA, which means you shouldn't be trading this. So anyway, so now this is where bears would sell. This is where bears would sell. This is where bears would sell. Do you understand that? So what does it mean if bears don't sell? By the way, 200 EMA, it's exactly inverse. Isn't that great? Exactly inverse. Like if you add up all the prices over 4 hours, over 200 4-hour candles, it comes out to be 200 EMA. Same thing on this one. Add up like they're not even the same currencies, right? Look at the 4-hour candles, add up all the 4-hour euro dollar candles, and throw on the exponential component, and you get the 200 EMA average. It's crazy. They're all exactly the same. Isn't that neat? If you calculate them, it's all the same thing. Even though they have different prices. Over 200 4-hour candles. Think of that. It's not like random, is it? Kiwi was a little bit weaker, but generally the same. Look at it's just crazy. Aussie dollar. Over 200 4-hour candles. You apply an EMA algorithm to it, and it says that's the 200 EMA average price. It's crazy. Okay, inverse, same thing, just flipped, because the USD is numerator and here USD is denominator. I think that's fabulously interesting. So all of this, to me, has to do with the US dollar. But they're all different calculations, right? But they're all, in this case, you look at it and they're statistically equal. So now, what does it mean if this is where bears sell, and this is where bears sell, and this is where bears sell, and down here, we're not there yet, but if that's where bulls would buy. But anyways, let's look at these three. If bears would sell in these zones and price, right, like this, okay, and price goes above that, do you think that's meaningful? If we go above here, if we go above here, if we go above here, I'd say, yeah, bears didn't sell. Now, do you remember I showed you a couple of other charts where I showed you that we're at prices where a bear would exit? How many people remember that? I'm like, look, this is where bears would exit, so therefore I'm expecting reversals. Just interesting to look at these on different time frames. This one isn't quite perfect. Okay. So one of the things you can do now, if you're a bull, is you make your decisions. You're like, okay, this seems to be a price that might be interesting to me. But technically, it's still an aggressive move to be a bull. The bear should sell this, okay? But now you can say, well, your alpha, your ability to outsmart the market tells you that what you're looking for in the next couple of days is this. So if this comes together slowly but surely, how will you behave? A bear sell at resistance and downtrends. That's why. Thank you for asking, by the way. I forget. If you don't know, guys, ask. Right? Don't be shy. I'm here to help. So if I say something, I'm like, I think it's obvious. Like, well, obviously bears are going to sell. And you're like, wait, what? Why? Then I will explain. Okay? This is where bears would sell. This, based on price action, is where bears would sell. And technically speaking, the market is still bearish. Okay? Based on lagging indicators. Lagging indicators. Lagging indicators. I use fundamentals and seasonality, which have nothing to do with your charts. There's no price on here. It's just time, basically, right? But even then, not necessarily. So there's a price and time decision, but your moving averages are lagging. Your oscillators are lagging based on what happened. Well, what happened isn't that interesting. I'm more interested in what will happen, and then I'll use these algorithms to measure where we are in the process. Has it turned bullish from a bearish mode, right? Has the modality changed, for example? Has the bias changed? Okay? And then I've created and gave to you guys at MentorTraders.com things like leading indicators. Here's tomorrow's buy zone. Holy schnicker-schnocker. Tomorrow's buy zone? Yeah. So I'm interested in tomorrow's buy zone more than today's buy zone, because as it's falling, I'm not really interested in today's buy zone because it's a downtrend. I don't buy downtrends, brah. But if this turns bullish, now I want buy zones. So I'm always interested in tomorrow's buy zones, next week's buy zone, next month's buy zone, because I'm looking at, well, where will the seasonality be next month? What will monetary policy be like at the end of the year? Okay? And saying, well, that gives me a bias. So now I use technical analysis to confirm the market conditions are favorable for my money. Okay? So you got to know how to be an investor. Okay? Think of it this way. If George Soros is the most famous Forex trader of all time because he broke the Bank of England and a bunch of other things, he good. But he doesn't look at any of these charts. He doesn't look at the charts at all. Nothing. Your pivots, your MACD, your oscillators, RSI, CCI, Elliott wave, completely unnecessary to an investor. And then, of course, to a trader, traders like scalpers, for example, they're all price over time. They're price action, scalping, technicals, everything is in the price. It'll dictate what's going to happen over the next few hours, next few days, right? Good. And yes, you can be successful as a trader. But for some reason, there's a dichotomy where investors and traders don't get along. I think you should have the mindset of both, the expertise of both. If you could be George Soros that can predict the next 5 years and be a scalper that can predict the next 5 hours, holy smokes. Okay. A new trader, don't say hope. It's not the language we use here. Okay. Anyways, you see what I mean, guys? So if you can put these things together, you could be wicked awesome. Why would you wait, Jeff? The number one thing, Jeff, is, first of all, you know what they're going to say tomorrow. If you don't know, you need to start doing your research today. The second thing is what they say tomorrow, will it strengthen or weaken the euro? You have to ask yourself that. Where do you want euro dollar to go? And here's the real big question. If you're going to trade it today, Jeff, like your question is, should you wait? Well, let's deal with the wait question. Do you anticipate the ability, if you traded today, to move your stop to break even before tomorrow? Okay? Jeff, do you think you'll be able to get your trade on and jam your stop before the ECB decision? Then if so, take the shot. Okay? If you can see the net, take the shot. If you can see the basket, take the shot. You can't score unless you shoot. Take a shot. Okay? If you're at half court, no. Pass it. Right? Don't be silly. Don't be stupid. Don't guess. Don't Hail Mary. But if you're in the paint and you see the basket, dunk it. Okay? Take it to the net. Take it to the hoop. right? I grew up with this, like, the Edmonton Oilers take it across the half and do the... Yari Curry's in the corner, passes it back to Paul Coffey. Oh, he fakes a shot to Gretzky. He scores! Woo! You're like, Edmonton Oilers from the 1980s. Yeah. Pass, it's open, shoot, scores. Okay? Get yourself into position. If you see it, take the shot. Okay? So Jeff says, I want to wait till tomorrow before getting in a trade. Price action has to be bullish first. Okay, I'm fine with that. Okay, I'm totally fine with that. Okay? So using my tools and using some fundamentals, it says if you buy a dip tomorrow, it'll be buying a dip around 18, and you'll jam your stop and let it run. And if you break even, it doesn't matter. It should be, Jim. I added a new section. Right? I added a new section, and in that, there's a Vimeo playlist. Yeah, it should be there. Are you on the basic bootcamp site or the swing version of the FX bootcamp site? Maybe I didn't save one of them or something. Yeah, I think I should just move you to the other one. Maybe I forgot to do that. I apologize. Well, thank you for being here, guys. Do you want to stay and watch the Canadian interest rate decision together? It's in 45 minutes. Yeah? Well, unfortunately, not even half of you have clicked the like button. Yeah, we could probably do a break in there, Alex. Okay. Am I going to trade the news? Well, I'm more interested in the energy complex right now in relationship to the Canadian dollar. So as far as the central bank decision, I'm more interested to see if they're going to say anything different and see what their outlook is. But as long as oil is weak, I think that's going to directly impact the value of the Canadian dollar. So will it turn into a trade? Digito, right? Cash asks for that. Probably not, actually. Okay. Thanks, Ruben. All right, we went from 60 likes to 88 likes, so 120 people don't like what's going on. What's going on? Nothing's right, I'm toned. Okay, but we can look at some kitty cat. Let's just see where we are. Oh, so it's gone a little higher. So I'm in, what, 71 and a half, 71 and 3/4. We're 72. So I'm up, what, 120 and 100. 120 and 100. Okay, cool. Whatever. Have you ever read The Richest Man in Babylon? Since I've been in Harvard for 5 years, I've done lots and lots and lots and lots and lots and lots and lots of reading. but nothing particularly interesting, nor things I wanted to read. I mean, it sounds interesting, but no. We can look at some commodities. Yeah, I'm sure there's a good book. There's a lot I want to read. Okay. Nothing's right uptone. You're a little late. I'm already done. Let's see what's going on here. Yeah. Yep. Danger zone, huh? I mean, it's hard to buy CAD after that. Maybe in a day or two if it works itself out. Okay. We were in my buy zone yesterday. I set this up for you. And now check it out. You got your fib entry and everything. Beautiful little 1, 2, 3. Okay. Target is 1962. I think 1950 is going to be more basic, so probably more like 1950. Okay. S3. Glenn, what time frame are you on? You must be doing day trades or something. We can try it on monthly. Okay, this is exactly monthly M2. Okay, this is why I highlighted it for you. I think even just yesterday. This is exactly the price you would want to buy gold on a monthly basis. So I hope you appreciate that. And now the technicals are pretty obvious. There's a giant bounce. You get your pullback, you get your entry, and now it's probably going to be more like sort of, I mean, I'm even thinking more like 1950. So instead of 1618, probably more like a 1382. Okay. Oh, nice. Okay. And then you would buy the next dip next week in here. Okay. Pretty standard stuff. Oh, thank you, Glenn. Thank you. I see that. Yeah. Well, ultimately, we don't know if central banks are buying, but that doesn't look like central banks buying. That just looks like the market's stabilizing. Sabatine, you sold gold at support on a monthly buying pivot? Really? No, S3 does not mean super support. No. Think about it. If you're at S3, it's because every person on the planet is selling. Does that sound like a good opportunity to buy? Have you seen the videos of people in like Thailand, and they're standing on the in the middle of the street, and all of a sudden a giant crowd of people starts running toward them, and they're like, "Hey, what's going on?" And there's a giant wave right behind the people running, coming into the street, and it's carrying cars and stuff. And you're like, huh. Not a good opportunity to like, hey man, I think I could swim this. Like, what are you thinking? Right? If every person on the planet is bailing on something, you're like, oh man, I got to get in on this. Like, what are you doing? I've always wanted to swim in a tsunami. Like, what are you, nuts? Okay. If everyone's running and you see cars floating, you should probably run uphill too. Those videos are amazing, huh? I saw one in Japan where the guy is in his car stuck in traffic, and he's looking out the left, and he sees like 3 blocks down the street because stuck in traffic, bumper to bumper. They're all going west or something, and he looks north or whatever it is. He looks to his left, and there's water. Like, he can see a river of water going down the street, but 3 blocks away. He's totally dry here. And he's like, what the heck? That's why he's filming. He's like, there's a river running down the street 3 blocks away. And he can't move forward, can't move back, can't get out. They're just bumper traffic. And then all of a sudden, like, people are running, like everything is running across this other way. But there's nothing he can do. He doesn't know what to do. He's just recording it. He's like, what's going on here? And all of a sudden, sure enough, boom, water comes around the corner and just lifts all the cars up. Lifts all the cars up. He's in the car, and the car lifts up off, and he's like, oh my God. And then lifts the car and starts moving it. All the cars in front of him and everything. It's really, really scary. It's really, really scary. Is that right, Cash? Very, very, very scary. Yeah. But when you see a tsunami like that, you should seek high ground. So like when the market is crashing, don't say, hey man, I need to be buying it. That it's way too aggressive. Where were you, Cash? If you don't mind me asking. Oh, from the temple rooftop. No way. Yeah. What country though? Kerala. Yeah, in India, huh? So you're on the water, huh? I don't know Kerala. We're going to pull it up right now. Actually, hang on. Oh, it's in the state. Oh, Kerala, state of India. Very cool. Oh, over there. Oh, that's got to be beautiful. That's got to be an amazingly beautiful part of India. Oh my God. Yeah, Goa for sure, huh? Do you love the Beatles or hate the Beatles? Oh yeah, Kerala. I totally see me in Kerala. I gotta visit. Oh my goodness. I can imagine. I gotta look at pictures. I'm gonna look at that. But yeah, of course. Oh, you were visiting. Oh, what a great opportunity. You're like, hey, it's Boxing Day. What can go wrong? Well, I know that's where the Portuguese visited. So I studied the history of economics, right? So I know why the Portuguese went to India, and it was because of what the Spanish were doing. So they had to go the opposite way. So they get to India. There's a lot of Buddhism in this part of India as well, which is very, very interesting. Um, yeah. Oh man, I got to visit. Home to elephants, monkeys, and tigers. Love it. Okay. Cool. So there you go. Gold all set up. Yeah, no, that's exactly what I'm thinking. I've always wanted to do that, and I think I actually need it, where you go and detox for like 2 weeks. You eat cucumbers and tea and meditate. I love the meditation part. I know the challenge, especially my form of meditation. I'd get antsy. I wouldn't want to start doing stuff, and that's the whole part of traditional meditation, like to turn that part off, to turn off the ego. Um, but I think you can do MTT for that, whatever it's called, MDT. Is that right? Anyways, you could take you could take some drugs and turn that ego off, but it'd be very interesting. I would like to actually do a detox, DMT. Yeah. Yeah, I think I'm gonna go to India and like, hey, I need to do this. I need to do this 2 week meditation retreat. I need to do it in 6 hours. So I'm just gonna sit under this tree and take this a DMT. I heard that stuff's weird though because it attacks the third eye of your brain where your third eye is, and there's a version now that just shuts your ego off. That's the only thing the drug does. No hallucinations, no lights, no nothing. Just turns your ego off, and apparently you're like, oh, just to see the world without fear or greed, right? Seems like that's probably something that John Lennon probably had done. Well, so KG, so I'm not a drug person, by the way. So it's just someone told me, but there's the typical version. What it does is it lights up your third eye in your brain. So all of a sudden you hallucinate, you see lights and patterns, and typical crazy, far out drugs kind of stuff, right? Right. But there's a version now they make where it doesn't do that. They can turn that off by doing something to it, right? So anyways, so they did something to it apparently. So you take the drug, you don't hallucinate, you don't see lights and all this because it's not lighting up. They turn that part of it off. But what it does do is turn off the part of your brain that is your ego, your greed, your fear, your wants, your needs, your desires, and it turns you off, and now you're like almost like an animal, like you're a deer. Not that you think you're a deer, but like, I don't know how much besides like hunters, like do deer want dream of having yellow Lamborghinis and all that kind of stuff, right? So anyway, so I don't know this. Yeah. So I don't know this stuff. I'm not a drug guy. But I thought that would be very interesting to have that part of your brain turned off, and you just like you see sort of like time differently, and your relationships differently, and your purpose and how important you really are. They're just you live maybe if you're lucky 80 years and then you die, right? So it opens up sort of a reality. So but but I don't, is that what it is, Alex? Like a non-soul inhibitor? I think it's more like a reality enabler, but I don't know. Again, I don't do drugs, so that's not my thing. It's not my bag, baby. All right, so let's go back to the dollar. Oh, for sure. See, it's unusual that this Swissy is so strong in this situation. And I think that's kind of, we'll have to pay attention to see how that goes. I think it was the pound dollar I did earlier. Do you remember? I said this leading to this. Remember? Based on fundamentals and seasonality. You guys remember that now? Now do you remember? So let's like pay attention now. It's not that it will, but I outline this as exit. This is a bear's exit. So bears leave. So the first wave of this, if you will, is offsetting short positions. So if now it goes up, the next step is building long positions. So this side of the equation are bears acting as they should, and this side of the equation is bulls acting as you would expect. Okay, the expected activity. Okay. Okay. So that's the interesting, and this is it's not even an expected target, but it's sort of like you're thinking full reversal. Okay. This is what we talked about before it did this, though. Okay. Before it did this, this is what we talked about. What, an hour and a half ago? It's a lot of 15-minute candles, an hour and a half. Okay. So now you have to plan your behavior. How are you going to behave in the future? Is this important? Do you think it's important? And if you believe it is important, what is the consequence of that importance? What are you going to do next? Okay? That's all this is. Amir, if you don't know what I'm talking about, definitely don't do anything. Do not do anything. If you have no idea based on what I just shared with you, you need to stop trading completely. Like I just force-fed this and you still don't know. Then you need to invest into some training. Yeah. Yeah, if you're spinning, I don't know what's going on. The psychological levels in play, though, you gotta acknowledge that too. So if you're a bear, I don't know how you'd treat this as a bear. This is not very bearish, but that's a scalp zone for sure. So that's why I'm saying if you're a bull, you gotta wait, right? If you gotta wait, you buy the dip. Another way of playing this, of course, is then keep adding layers. We can add another layer, and it's confusing if you don't know what's going on, but if you're adding layers, then you do know what's going on, and you look at each layer independently. So let's say on 15-minute chart, we want to look over the last 34 candles, and we'll do it that way. And technically, this is like this statistically is a little bit bearish, but we just went 3 standard deviations from the mean. This is way, 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 way outside of the scope on a 15-minute chart. Technically now, we're only doing price and time and doing some basic statistical calculations. But this is an outlier, is how a statistician would talk about it. This is an outlier, but it may be a game changer as it will have a quite an impact. The reason it's an outlier is it can change the rest of the data set from bearish to bullish. But you know, when you're doing a survey, that outlier would kind of ruin the data. But I think we're interested in the fact that this was very, very statistically bearish and then trending bearish over a reasonable period of time, like days. And then suddenly, at exactly the price you would figure it would bounce, which would be 129, all of a sudden, holy schnicker-schnocker. In 2 hours, we rallied 100 pips, made a higher high, went 3 standard deviations from the mean. Is that statistically and technically important? Yeah, probably. So what do you do about it now? Okay? Okay. So it bounced at 129. In 2 hours, went to 130. Okay? And now what? Now what are you going to do? If it dropped to 129.50, would you buy it? If it dropped to 129, would you buy it? And if so, under what conditions? You could even write it down. Head and shoulders. I guess so. Not. Yeah. Yeah. I guess if you like the patterns on, sure. Yeah. I guess so. See, what's most interesting on, is that you, based on technical analysis, you expect bears to exit here. I don't care about the head and shoulders pattern. But based on just technical analysis, you expected a reversal to happen somewhere in here. There's a pivot at this line, and then there's a psych level at this line. So this is even like doubly important right in here. Then at the open of the New York session, you have the time and the price in which you would expect a change in behavior in the market, where bears would exit. I don't even think bulls have bought yet. This is just bears exiting, okay? You see what I mean? So you have all this going on, and you knew it yesterday and the day before. So now you get down there and you're like, oh, look at that. Today we're right there where I think something will probably happen. And then in 2 hours, it does more than it's done in a day and a half, in the direction you would expect. So a head and shoulders, like, yeah, I guess so. But I think the other things are much more important. Like that this is where you would expect a reversal, and you know you're a bull. You know this is a price. You know this is the right time. And then you get this chow. Okay, buy the dip. So it's more like, okay, it did all those things you'd expected. Are you going to buy the dip or not? That's all. Okay? You see what I mean? Amir, just stop. Okay? I don't know what games you're playing or how we're supposed to help your emotions, or I don't know what's going on, but you've been told before. It's my ringtone, YouTube. I'll throw in an ad. Stupid YouTube. All right. That's my song. That's my song, Bubba. All right. Oh, we got about 15 minutes to the kitty cat. Kitty, kitty, kitty cat. Kitty cat. Let's go, cat. Boom, shalaka-laka. Let me get out the TTN, tradethenews.com. Tradethenews.com. So they're going to give us some intelligence.
Percent at 37.28 after the rout we saw yesterday in energy markets.
Ooh, the Europeans are more confident about the future. Right on. Mexico forecasting 3.5% inflation. Ooh, that's good for us carry traders. Ishkor, if you like news fed to you in real time, then yeah.
And Bank of England receiving an offer to cover ratio of 2.97 at the latest purchase of 1.47 billion in sterling, 1.47 billion sterling in gilts of 7 to 20 year duration. That compares to 2.67 offer ratio previously.
Weird. All to a dead page, huh? Just funny. Look at that. Never picked up. It never recovered. Just amazing. So here's the 2008 crash. So I used to watch this a lot. And then look at that. Just never recovered. It's stupid that we're at 1,400. We used to be at 11,000. And it dropped from 11,000 to 1,000, and there's never really, it hasn't even made it above 2,000 in years. Oh my God, it's just amazing. Amazing, just amazing. So I don't know if I'd use it anymore. I mean, it's just amazing. Mortgage applications up. That's cool. Three 3.0. Very cool. So yeah, Mexican CPI way over 3. That's going to be good. So this is something I like on Trade the News. Jim Cramer, buy these, be cautious of those. It's all stock, right? Dawn Capital closed another $400 million fund to focus on B2B. Very cool. I don't know Dawn Capital. Oh, Taboola and Outbrain called off their merger. I didn't even know they're merging. That's interesting. U.S. Agency for International Development, which has been on the front lines of the battle with coronavirus, is about to shut down the task force it set up to tackle the pandemic. Okay, nothing going on today. We got some up. We got some bid on the S&P. Euro not suspending the Brexit negotiations. And here's the thing, more confidence in Europe. Very nice for the euro. About 9 minutes till the kitty cat news. RBA buying a couple of bill and bonds, propping up the Australian economy. Do you hear like the largest, was it 3-year issuance for the United States just is occurring this week? Something like crazy, $50 billion or something crazy. The state of Victoria reports 76 additional coronavirus cases. It's nothing compared to the United States. We do like 2,000 a day. Come on, Australia. Yuan setting, great. President Trump to announce further troop withdrawals from Iraq and Afghanistan. I suppose if you only got 5K there, 5 to 3, I suppose. New Zealand 2-year swap rate turns negative for the first time. Whoa! RBNZ could cut cash rate into negative territory as early as February. Well, that ain't good. UBS says negative RBNZ official cash rate in 2021. These guys expect negative cash rate by the NB. So it looks like RBNZ is going negative, huh? Everyone. ANZ, everyone's going negative, huh? So, sucks if you want to buy the Kiwi. Is that right, Master Trader? Email me, wayne@fxbootcamp.com. Japan closed down 1%. Korea closed down 1%. Australia closed down 2.2%. New Zealand lower by Shanghai lower. Lower. India lower. Yeah, everyone was lower. Bad day yesterday, huh? About 4 minutes now to the news.
Top there looking for JOLTS job openings for July in the U.S. expected at 6 million, prior was 5.89 million. Also get the Bank of Canada rate decision, expect to keep rates on hold at 0.25% for Canada.
Okay. Cool. So that's what's coming up. I'm going to put everything on Confluence. Swissy's really strong today. Just amazing. Aussie stronger than CAD. CAD stronger than dollar. CAD stronger than yen. Swissy stronger than CAD. So this is still all USD weakness and Japanese yen weakness. So it's a macro play, which is good. Thank you, Master. There's a question about what about Euro Pound based on Brexit? Then trade it. It's not my thing. It's the geopolitical trade. You could totally do it. It's just not my thing. I'm a macro trend trader.
Under a minute, City Bank of Canada rate decision expected to keep rates at 0.25%, and the U.S. JOLTS job openings for July expected at 6 million.
Can you guys hear Trade the News? Can you hear the Trade the News guy all right? Wonderful. Excellent. Thanks for hanging around all this time, by the way, guys. We're over 2 hours right now. Please like and subscribe, all right?
Bank of Canada rate decision and JOLTS job openings, just a few seconds. $6.62 million for JOLTS, about the 6 million expected for July. Bank of Canada keep rate on hold as expected at 0.25%. Prior JOLTS rise slightly higher to 6 million from 5.89 million.
So here it is. Here's
Bank of Canada saying economy will continue to require extraordinary monetary policy support.
Bank of Canada saying they'll keep rates at the current level until capacity is absorbed.
See, look at this. It's not even one page, and yet 95% of retail Forex traders don't have the gall to download central bank statement and read it.
Bank of Canada affirming that they'll continue buying 5 billion Canadian dollars per week of Canada bonds.
Isn't that amazing? It just took me 28 seconds to read that, and I highlighted 5 or 6 important things. Isn't that cool? That's all you have to do to be professional and be better than 95%. Okay. Where do I get my news? How do I do my fundamental analysis? That's how I do it. I go to
Or from the Bank of
go to the
Canada
website.
saying they will continue with its quantitative easing program with large-scale asset purchases of at least 5 billion Canadian per week.
Yeah, 20B a month will do it, huh?
And stock markets here in the US have continued to push higher. The Dow up about 400, the S&P up more than 50, and the Nasdaq Composite up 200. The VIX near the lows of the day, down about 0.6%. Russell 2000 up 1 1/3%. Crude trading up 1 1/3% as well. The dollar index down 0.25%.
Yes. Yeah, less strong. Yes. The way to say it is the supply of money has gone up, Jeff. Okay. On the bounce coming? No. Nothing's changed. Okay. So what did I say I was more interested in regards to the value of the Canadian dollar? Are we in a currency war? No. Okay. Can I explain quantitative easing? Let me do this. Gotta close some things. Where's my... I need to turn Trade the News off, I think, because he's going to talk over me. No, wrong one. I guess I turned it off. No, I doubt it. Did I? No. Baltic Dry Index. Yes, I turned it off. Good. What was I going to say? Oh, can I explain quantitative easing? Yes, I can. So let's go blank. So let me ask you this. Let's do it this way. Where's my drawing tool? We'll do quantitative easing and its impact on a currency. What is quantitative easing? What is QE and what is the purpose? Okay, so great question. So let's go through this. So quantitative easing is when a central bank buys bonds from the market. Okay. But what does it actually do? QE, Kishkor says, is QE the same as asset purchasing? Yes, typically it's them the central bank buying bonds, but if it's asset purchasing, they could be buying other things too. But all of this is actually pretty new, and even quantitative easing was a brand new thing. When I started trading currencies, I don't know, 15, 20 years ago, there was no QE. We were even debating whether inflation targeting was even something a central bank should do. So anyway, so what is quantitative easing? So let me explain it this way, okay? To do so, we're going to need to do some economics. Oh, I'm sorry, I know, economics. All right, let's do this. So you have the price of money, and you have the quantity of money, okay? And we have a demand curve that slopes down, meaning when the price is high, you don't need a lot of quantity, okay? If you could buy a Porsche for $1, if you were $10, if you had $10, you'd be rich, right? If the price, right, or purchasing power or the value are all different words, right? If the value of $1 is low, you're going to need a lot of quantity. Okay? No, this isn't 1 over R plus E. Okay? That's the money multiplier. Okay, on? Okay, so anyways, this is if money is powerful, you don't need a lot. The Q would be low. Okay? If the purchasing power of $1 is low, you're going to need a lot. Okay? You got that concept? That's why the demand slopes down. And then what direction does the supply of money slope go? If the demand slopes down, what's the slope for supply? Give me a direction. Pierre says up. Or sorry, opposite. KG says up. It slopes up. Right? No, wrong. Okay? It's vertical. It's not up like a traditional supply and demand. It doesn't make an X. The supply of money is the amount of money. It's finite. It's like that's how much money is in the economy. That is the supply of money. That is it. It is that. That is it. So it's not like supply and demand typically creates an X. There's just that amount of money. That's all there is. Okay? All right. So there's the supply of money. Okay? So now I have to label the chart. Because remember, a good boy always, right? Money, supply. Okay, so let's talk about this. The Fed does quantitative easing. We know quantitative easing is them going into the market and buying something. What they do is they buy a bond. Where do they buy the bond from? Where do they buy their treasury? See, a treasury is simply a government bond. You can buy a corporate bond, or you can buy a government bond. A government bond is a treasury. So quantitative easing in this case is the Fed, the central bank, buying a government bond. In the United States, I believe there are only 12 bond dealers. So if the Fed called up the Treasury, see, the Treasury is the one that creates the government bond. And if the Fed bought the government bond from the government Treasury, then the government would get money. And the Fed would get the bond. And nothing would change in the supply, because it just goes to the government. So that wouldn't have any effect, except the government would owe the Fed an interest payment, right? Okay. So what is the point of quantitative easing? Well, the government is trying to support the economy. In fact, we were just looking at the Bank of Canada statement. That's where this question came from. The Bank of Canada is continuing quantitative easing program, large-scale asset purchases of at least $5 billion a week of Government of Canada bonds, Canadian treasuries. But also, it says somewhere else, as the economy moves from reopening to recuperation, it will continue to require extraordinary monetary policy support. Quantitative easing is extraordinary monetary policy support. They're supporting the economy. Okay, they are supporting the economy through monetary policy. So let's figure out what that means. The Fed, in this case, let's talk about the United States, but it could be like the Bank of Canada is buying bonds, but not from the Canadian government, but from a Canadian bond dealer. The bond dealer calls up the government and says, we need to buy some government treasuries. So in this case, the Fed calls JP Morgan. The JP Morgan calls the U.S. government treasury and says, we need to buy $1 billion in treasuries. So, right? So now JP Morgan buys the treasuries. They have less cash on their balance sheet than they used to because they gave the government the money. They loaned the government the money. So they're short cash. But now they own this asset. They own the government treasury. But that's not what JP Morgan wanted to do. What did JP Morgan want to do? They wanted to sell that asset to the Fed because the Fed called them up and said, can you get us some government treasuries? They're like, sure. So what they do is they mark up the price, essentially front running, right? And they sell it to the Fed. The Fed just calls them up. We'd like to buy $1 billion right here, right now. So JP Morgan says, not a problem. Hang on a second. They pick up the phone on the other line, call the Treasury. Okay, we'd like to buy $1 billion of U.S. government bonds. The government says, sure, not a problem. JP Morgan transfers money to the government. The government transfers this bond. It's just a piece of paper that says, on a certain time and a certain date, we'll pay you back. Okay? Then JP Morgan then picks up the phone again with the government on, or with the Fed on the line saying, we got your treasuries. We're going to mark it up. You're going to pay a commission, basically, and we'll sell it to you. Well, why would they do that? Well, okay, remember JP Morgan now. JP Morgan. Okay, they have assets and liabilities. Okay. Okay, so they used to have cash. Okay. But what happened? Cash went down 1 billion, but they now have 1 billion in bonds. The bonds went up 1 billion. So the assets on the balance sheet haven't changed. Cool. So what happens next? The Fed clicks a computer key and goes click, 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 click. Okay, we have $1 billion now, right? Plus 100 million more. So JP Morgan sells the bonds to the Fed now for $1.1 billion. The bonds go away from the balance sheet. Okay. And JP Morgan gets an extra 100 million in cash commission or whatever, right? And so cash goes up. The supply of cash actually goes up. But the interesting thing is, the billion never existed. Okay, so anyways, let's get away from this. The point is now, instead of the Fed giving the government money, the Fed bought the bonds from JP Morgan. They created the money. They didn't print it. That's what the Treasury does. The Treasury prints dollar bills. The Fed created, they actually, with a keystroke, created $1 billion or 1.1 billion or whatever. And they bought the bonds from JP Morgan. So now you look at the Fed. Okay. And the dealer, JP Morgan. Okay. So the Fed gave the dealer cash and the dealer gave the Fed the bond. You see this? So now the Fed's balance sheet has gone up. Right? Have you heard that? Like the size of the Fed's balance sheet. Do you ever hear that in the media? What are they talking about? How many bonds does the Fed own? But they give the bond dealer the cash. So now the dealer doesn't have the bond, they have the cash. That goes into their bank account. Okay? You know what's clever? Is 10% of that money goes back to the Fed because it's required they keep that money at the Fed. Right? So let's say 10%, 100 million. So let's say now they have 900 million left, 100 million parked at the Fed. And this is where your 1 over R plus E comes in. But you'll have to take the fundamentals course if you don't know what the money multiplier is and all that. We're not going to go into that today. Okay? All right. So I just want you to understand that it's the Fed creating money, not printing money, creating money, and why they don't buy it from the government, but instead buy it from the bond dealer. And now the money now, the new money that the Fed created is now in JP Morgan's bank account. And JP Morgan is in the economy. Okay? So, check this out. So the amount of money has gone up. The Fed created it on their computer.
Less dramatic than the stress test scenario from April.
I knew it was open. Where is it? Hang on, I couldn't find it. Live streaming. No. Where is it? Baltic Dry Index, Forex calendar. I don't know what screen it's on. It must be this one. And sure enough, there it is. I had it covered by... Okay, so let's get back to this. Okay? All right, so the government doesn't buy it, or sorry, the Fed doesn't buy it from the government because they would just go into the government and that's that. So they allow JP Morgan to front run them, and JP Morgan buys the bonds, and then the Fed gives JP Morgan the money, and now it goes into JP Morgan's bank account. But don't worry, they end up lending it out. They're banks. That's what they do, is they lend their money out. Okay? And then it goes into the real economy, and eventually it goes into your mortgage, and then your mortgage goes to your broker, and your broker goes out and buys a used BMW and whatever, and then the car dealer gets money, and then it just goes all the way through, and the car dealer buys lunch, and the waitress at Applebee's gets money, and she goes out and buys groceries for her baby, and it trickles down. Okay? It just trickles all the way down over time. But what we do know is the reason Fed was buying treasuries was to put money into the economy. That's what quantitative easing does. So now check it out. The quantity of money went from supply 1 to supply 2. Always label, okay? So what's happened? Well, we used to have an equilibrium price of, we'll call this P star, okay? And then we have a new supply Okay, equilibrium 1, equilibrium 2, and price went down. See what happened? The increase in supply, so quantity 1, 2, 3, 4, 5, 6. So we went from 6 quantity to 8 quantity. So now let's call it like, so JP Morgan bought 2 billion, or the Fed bought 2 billion from JP Morgan. Okay, so we went in billions or whatever, right? So the supply increased and the value per dollar, or purchasing power per dollar, fell with the increase in supply. The 10x comes from 1 over R plus E. Okay. So again, if you are interested in this kind of thing, if you go to fxbootcamp.com, join, and like you guys, as you should know, it's almost 80% off right now because of COVID. In the fundamentals course, by the 3rd or 4th hour, you're managing the balance sheet of a commercial bank. And then once you're able to do that, I can take you through these types of lessons so you understand how to manage the balance sheet of a central bank to get the outcome. So now what happens here? Well, the value goes down, so you need more money to buy stuff, which pushes up inflation, or stimulates you to spend money. So one way it stimulates is interest rates, its impact on interest rates. Well, if interest rates are low, there's no reason to keep your money in the bank because you're not earning any interest, like hardly any interest. So you're like, well, I got $1 million, but I earn like $12 a year in interest. So like maybe you should invest your $1 million. So you okay? And that's what they're doing. This is when these decisions are made, like if you earn $0.25 by putting it in the bank, but the stock market goes up 20% a year, okay? Which one are you going to do? If you leave it in the bank, you earn nothing. If you put it in the stock market, you earn 12, 13, 14, 15, 20% a year. So you're like, well, I can't leave it in the bank account because you need 2% minimum to live, right? And the bank is paying you 0.2. So you're like, well, I can't leave it in the bank, so you have to invest. Where do you invest? The stock market. Okay? That's why the stock market goes up. And why does the Fed want to do this? Well, first of all, they want to increase asset prices. Again, what's an asset? Real estate? Your retirement account. Okay, the reason they're supporting the economy is they're trying to get asset prices up, which is a form of inflation, which is they're fighting deflationary pressures. So the stock market has to go up, or QE is designed to push the stock market up. It's designed to push up housing prices, which then pushes up consumer spending. And your spending is someone else's income. And when your income goes up, jobs are created and more spending because you feel good about your job. Your house price went up. The stock market went up. So your retirement account is up and you feel good. So you do more spending, which is someone else's income, which creates jobs, which creates more spending, which creates income. And if you don't own your house and if you don't have a retirement account, you're poor and you will stay poor. But if you have a little bit of money and you have a retirement account and you have and you own your own home because you have a decent job or you're a good Forex trader, then think of it this way. The Federal Reserve Bank of the United States does whatever it takes to make you rich. Now, a lot of people will bitch and complain. They're like, well, that sucks. That's for the top 1%. This is all rigged. Well, then why don't you get a good job and have a retirement account in the stock market and own your own house so that the government makes you rich? Like, get in the game, right? Don't hate the game, be a player. It's the quantitative easing is designed to increase asset prices. So what do I preach and preach and preach and preach? What did I preach about like just a few days ago? For like 2 hours, I didn't even do Forex. So I just preached. I said you need to own assets. Because when things get bad, the government will do whatever it takes to make sure the value of your assets go up. You need to own. You need to be an owner. You need to be a boss, right? Bosses own. They have power. You need to own assets. Real estate and stock, easy, right? You own your home? I own my home. Do I have a retirement account? Yeah, I'm contributing to it today. Why? Tax-free compounding. Tax-free compounding. And do you guys remember I explained to you just the other day too, if you own your own Forex trading business, you can pay yourself before you pay the government. If you defer, like you can't just like take 50 grand and go out and buy a used Mercedes. You'll have to pay taxes first. But if you say, I'm going to defer my pleasure, I'm going to put it in a retirement account, I can do the $50,000 before taxes. It's like you never made the money. So now you put it in an account that grows 10% a year for 30 years. And then you're like, how much did your 50 grand grow? And then in year 2, 50 grand, year 3, 50 grand, 50 grand. And I know when things get bad, the government's going to bail me out. Why? I'm an owner. I own assets. And they're like, oh my God, we gotta push asset prices up. Damn right you do. Right? So that's the game. Like, you can't hate it. Be a player. Don't hate the game. Be a player. You should, right? So anyways, whatever. So this is what quantitative easing does, is it's the government supporting asset prices by increasing the money supply, lowering the value, which means it creates stimulation. It lowers the interest rate, so you have to invest. You shouldn't save your money, right? You shouldn't be in cash. Cash sucks. Cash is horrible. You got to deploy your cash and buy an asset that will go up in value and create income for you, passive income. So, and then when things get bad, the government will bail you out. Oh my God, that's beautiful, right? So that's what quantitative easing does. If the central bank simply bought it from the government, that's not cool. It just doesn't do anything for the economy. If they buy it through the bond dealer, they put the money into the economy, increasing the supply, shifting the supply curve to the right, lowering, because demand will be the same, lowering the value, creating inflation, also making exports more competitive, right? Forcing every American with a savings account to get their money out of their savings account and into the market through investment. Then driving up demand for assets like gold, real estate, and more stock market. And then all of a sudden you get in a situation where we're in a horrible, 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 horrible economic crisis. And if you're in the stock market and if you own your own home, you're filthy, stinking rich. This is a great year. If you bought in March and April, some stocks are up over 100%. You've doubled your money. Why? One part of the why is quantitative easing. This is what the Bank of Canada is doing and many other central banks. But what's the other part? What really happened? Okay, what really happened in the this more recent recovery? Was it due to quantitative easing? No, it was the effect of quantitative easing, And again, like I'm saying, if you're trying to live, if you're retired and you're trying to live off 2%, right? And the bank is paying you 0.2%, right? Then you are forced to invest your money by either buying bonds and stabilizing corporations, corporate bonds, or exposing some of your portfolio into stocks, pushing up Apple, pushing up Facebook, pushing up Google, pushing up Zoom, pushing up Netflix, so on and so forth. Because you can't save. You can't. You cannot. You're like, I cannot be in cash. I cannot be in cash. I cannot be in cash. I have to get in the market. Okay? I have to own. And because you're forced to do it, you have stock markets at all-time highs because there's nowhere else to put your money. You have to deploy your capital. You have to own shares of corporations or lend money to corporations through bonds or own real estate, for example. Either own your own home, which goes up through amortization, right? And appreciation. Or you invest into like something that you can collect rent on and have income. Okay? Not just your mortgage falling and the neighborhood prices going up, but actually earning income on top of that, right? You are forced to do it. Forced. Which means everyone else is forced, which pushes up asset prices. So if you weren't buying in 2008, and I begged people, right? Or even in March, remember? I'm like, create your list. You cannot save your way into prosperity. You guys remember those conversations? You cannot save your way into prosperity. You have to own. You got to buy when prices are down. You got to own something that will go up in value. You got to own something that will provide you income, because the more income produces, the more it's worth, and the more the price will go up, which is this virtuous cycle. Or you got no money, you got no car, you got no woman, and there you are. I think that was Plato, wasn't it? Or Confucius. No, Confucius doesn't rhyme. Anyways, I think you got it, right? So, increase of supply, lower price, lower value, which changes your behavior into pushing up asset prices. So the moral of the story is you need to be an owner, not a renter. You need to be an investor, not a consumer. And ultimately, you won't work for a job. You will own cash flow. And your money will work for you. And you will not work for money. Very cool, right? So I'd like to thank the person that asked the question, what is quantitative easing? That's what I think it is. Yep. All right, so I can go back and save this part of the video, which I think is super ridiculously cool. Thank you, YouTube. Cool, right there. What do I have to do here? Oh, I have to create a title. What is QE and what does it do to Forex and investing? Cool, I just created a highlight reel. How cool is that? Neat. All right, what do you think, guys? We are coming up to 2 hours and 40 minutes. I lost about 30 people, so I think the QE thing sucked. And nobody clicked like in the last half hour, so I apologize. Apparently, yeah. So I guess we'll just call it a day, and we'll start again tomorrow. Tomorrow is Wonderful Thursday, so if you're in my live group on Thursdays, we meet and such. So I hope I see you over there. Victor says, freaking amazing. Cool. Yeah, well, there you go. There's cheaper than Harvard, let's just say. Cool. So anyways, thank you for staying to the end. Thank you for your loyalty and respect. Thank you for all that you do and the hard work that you put into this and the professionalism that you bring every day. I appreciate it. I appreciate you. I like our time together too. So, without further ado, peace on earth. May the pips be with you. May our profits be above average. See you tomorrow.